A few days ago, Pakistan's Finance Minister Mohammad Aurangzeb offered an optimistic outlook on the country's economy, asserting it could grow tenfold faster. Speaking at a World Bank event on April 23rd in Washington, he claimed that with the implementation of economic reforms, Pakistan's economy could expand to $3 trillion by 2047, propelling it into the ranks of middle-income economies. However, while the finance minister's optimism is commendable, without concrete actions such as long-awaited structural reforms to the country's economic framework and a realignment of its regional policies, these statements may amount to little more than rhetoric. The need for structural reforms to overhaul the country's economic management has been long overdue. Every external creditor, whether bilateral or multilateral, has identified this as a prerequisite for extending any further credit lines to Pakistan. The reluctance of successive Pakistani governments to undertake these necessary reforms has directly contributed to the current economic crisis facing the country. Moreover, the situation has been worsened by the unnecessary loans obtained by Islamabad, notably from China as part of the China-Pakistan Economic Corridor, CPEC. Pakistan's military-dominated establishment gambled on CPEC's economic potential to revive the nation's fortunes, but it has proven to be an economically unviable investment, ultimately worsening Pakistan's economic situation. As a result, Pakistan's foreign exchange reserves have significantly depleted, reaching a mere $8 billion as of February 2024, barely enough to sustain 8 weeks of imports. Simultaneously, Pakistan's debt-to-GDP ratio stands at nearly 75%, with its external debt surpassing $131 billion as of March 2024. According to IMF estimates, an alarming 50 to 60% of the Pakistani government's revenue is consumed by the interest payments on its debt. Furthermore, various global credit rating agencies, such as Moody's, have consistently flagged Pakistan's averseness to reforms, and as such, consistently downgraded Islamabad's credit ratings. For example, in its February 2024 assessment, Moody's assigned Pakistan a Caa3 rating, describing its economic situation as increasingly fragile, with heightened risks of default, citing concerns about Pakistan's liquidity and external position. Even as its economy stands on external life support, the Pakistani establishment has shown reluctance to introduce structural reforms in the country's economic management. This is despite every external creditor, including countries such as China and Saudi Arabia, conditioning further financial commitments to Islamabad on these reforms. This reluctance is particularly significant given a bilateral creditor like China, which has earned the reputation of using debt-trap diplomacy to exploit the financial vulnerabilities of poorer countries, has explicitly asked Pakistan to undertake economic reforms. Similarly, Saudi Arabia, which previously demonstrated financial benevolence towards Islamabad by extending generous yet unaccounted aid, has voiced its concerns over the Pakistani government's commitments to reform the economy. Interestingly, the Saudi Kingdom, which traditionally extended aid and grants rather than loans to Pakistan, has discontinued this practice, citing chronic corruption that resulted in the diversion and dissipation of a significant portion of such aid throughout the government hierarchy. Instead, Riyadh has pledged to provide only grants and loans to its partners like Islamabad, but with preconditions. Despite widespread calls for reform, the Pakistani government continues to play the cat-and-mouse game with the reforms, dragging the country towards its financial default, which appears a matter of when and not if. For Pakistan to emerge out of this quagmire, it is paramount to not only overhaul its economy, but also realign its regional policy. It may help the Pakistani memory that the country stands in a position where its neighbor, India, was 30 years ago. In the 1990s, as India's foreign reserves dwindled, the country was compelled to seek an IMF loan of $2.2 billion in 1991, offering 67 tons of gold as collateral security. Confronted with this monumental economic crisis, Indian leadership rose to the occasion and initiated economic reforms. It was this leadership and the courage to make bold decisions that propelled the Indian economy onto a developmental trajectory, eliminating the need for external assistance. Consequently, India's GDP surged from a mere $275 billion to over $3.7 trillion by 2023. It is not only India that has adopted such measures, as dozens of Southeast Asian countries transformed from poor to highly productive economies. However, it appears highly unlikely that the Pakistani government is genuinely committed to implementing any significant structural reforms in the country's economy. Instead, it has already begun the process of seeking another IMF bailout package. According to Pakistan's finance minister, discussions on a new financial package will commence in May 2024. The Pakistani government must acknowledge that recurrent IMF bailout packages alone will not lead to enduring fiscal stabilization. Without tangible structural reforms to the country's economic architecture, these bailouts will amount to little. If IMF bailouts were a solution, Pakistan would not have been compelled to turn to the International Funding Agency 13 times already. Alongside these economic reforms, Pakistan must recognize that its economy cannot flourish in an atmosphere of insecurity, and hence needs to realign its regional policy and improve relations with neighboring countries. Just as it requires a stable Durand Line border with Afghanistan, and to make peace with its own creation, that is, the Afghan Taliban, it also needs to improve relations with its other two neighbors, India and Iran. Instead of persisting with a failed policy of using proxy terrorism against New Delhi, it would be advantageous for Pakistan to foster better relations with India and benefit from its ever-increasing economic profile. It needs to recognize that there can be issues, how contentious those may be, that should not stand in the way of engaging economically. The example of Sino-Indian relations should be instructive for Islamabad. Despite contentious border issues, New Delhi and Beijing enjoy robust economic relations. This is manifested by the staggering volume of India-China bilateral trade, which has risen well above record USD 136 billion as of December 2023. In this context, a recent statement from Pakistan's Foreign Minister Ishaq Dar expressing a desire to revive economic engagements with India. However, the Shehbaz Sharif government must move beyond mere assertions and initiate diplomatic maneuvers with New Delhi to make this a reality. Similarly, Pakistan must prioritize its national interests, with economic stability being paramount at present. Therefore, it is crucial to enhance economic engagement with its other neighbor, Iran. It is a shame that bilateral trade between Iran and Pakistan has not even reached USD 1 billion as of 2024. Had Islamabad adopted a more accommodating approach towards Tehran, it could have capitalized on Iran's international isolation and positioned itself as Iran's economic frontline, much like the United Arab Emirates. That could have very well stabilized and provided a valuable cushion to its economy. Therefore, unless Pakistani leadership rises to the occasion and initiates tangible structural reforms to overhaul Pakistan's economy, there can be no recovery. As such, the way Pakistan's civilian cum military leadership is behaving, the dream of expanding the country's GDP to USD 3 trillion in the next 20 years seems to be light years away. So this is it for today's episode. Remember to like, share, and subscribe for more informative content. Until next time, stay curious and keep exploring.